Investing is a great way to build wealth. Due to rising inflation and economic fears, many investors are unclear how to make safe, high return investments. There are several ways to invest, from lower risk money market accounts to higher risk equities or real estate. Understanding your risk tolerance is crucial to developing a winning portfolio, as every investment is risky. Diversify your portfolio by include safe and riskier items. In this video, we'll have a look at the top 10 assets to invest in 2023. The 10 best high-yield investments are ranked from least to most risky. Now, let's get into it. Number 10. NASDAQ 100 Index Fund. Index funds are a good option for investors who lack the expertise and time to analyze specific firms. They expose you to a broad selection of stocks that follow an index, like the NASDAQ. The technology-focused NASDAQ 100 Index includes the 100 largest NASDAQ companies. It offers exposure to Microsoft, Apple, and Meta, Facebook. Index funds offer quick portfolio diversification. Another company's growth might offset one's bad performance. Long-term investors might choose a NASDAQ 100 Index fund. It is ideal for investors willing to withstand volatility for a high return. If you have a long way to go before retirement, you can bear the current volatility with confidence. Number 9. S&P Wink with tongue sticking out 500 Index Funds. S&P Wink with tongue sticking out 500 Index Funds, although riskier, may beat savings accounts and government bonds. Investing in an S&P Wink with tongue sticking out 500 Index tracking stock portfolio involves buying an index fund. These equities include Amazon, Apple, and Microsoft. An index fund, unlike an actively managed mutual fund, tries to mimic its index's performance. Owning shares in a number of companies across sectors diversifies your portfolio. Index funds are a high-yield choice for long-term investors. The S&P Wink with tongue sticking out 500 Index has typically returned 10% annually, even though bonds are less risky than stock funds. Longer time horizons allow you to ride out market swings. Number 8. ETFs. ETFs aggregate investor money to buy a range of assets that may be bought and sold like stocks. They are ideal for young investors with a long time horizon who do not have the time or skills to analyze individual firms. ETFs are a good option if you want to invest but do not know where to start, since they have a low entrance barrier and do not need much money. ETFs offer quick diversification since they expose you to all the businesses in their index. As with S&P Wink with tongue sticking out 500 Index Funds or NASDAQ 100 Index Funds, one firm's bad performance may be offset by another's great performance. Your time horizon and risk tolerance will decide whether you can handle high-yield investments. Certain investments may be preferable for long-term investors who can take on more risk and generate higher returns. Number 7. Corporate bonds. Corporate bonds, like government bonds, are issued by corporations. Companies may issue two kinds of bonds to generate money. Investment-grade bonds are frequently issued by larger companies with a longer track record of steady profitability, making them a safer investment owing to a higher possibility of repayment. Poorly performing companies issue junk bonds. They are riskier, but provide higher returns than investment-grade bonds. Risk-averse investors wanting a higher return may consider corporate bonds. Even if they are FDIC insured, they are nonetheless riskier than stocks. Number 6. Municipal bonds. Cities, counties, and state agencies issue municipal bonds to fund public works projects like building roads or schools. Municipal bond interest is frequently tax-free, unlike corporate or federal bonds, but not always. Municipal bonds may be organized in two ways. GOs are government bonds that are not backed by a specific project. Public money or property taxes may fund them. Revenue bonds are backed by a highway or toll roads revenue. They repay investors with project income. Revenue bonds are riskier than GOs since their payout depends on project success. These bonds are less risky than corporate bonds. Like other bonds, municipal bond values vary with interest rates. If rates rise, you may lose money. They remain a safe Tax advantaged investment alternative. Number 5. Government bonds. When you buy a government bond, you are effectively lending the government money, which is then utilized for things like supporting infrastructure projects or paying off the nation's debt. For instance, a bond is a fixed income investment since it pays the investor an annual interest payment when it is issued. The bond's principal is returned to the investor at the conclusion of the bond's tenure. Because they are backed by the full confidence and credit of the United States government, government bonds are among the least hazardous investments available. The returns are thus far lower than those of other assets like equities. Government bonds alone are probably not going to help you achieve your long-term investment objectives or support your retirement. Number 4. Money market accounts. Another type of interest-bearing savings account that is federally insured is the money market account. They are almost identical to CDs or high-yield savings accounts, with the exception that they give you more options for money withdrawals, although you are still only allowed 6 per month. The best option for those looking for a low-risk investment that still allows access to cash when needed is a money market account. They function well as a short-term savings vehicle, similar to a high-yield savings account, for near-term purchases like a car or for accumulating an emergency fund. Number 3. Series I bonds. The U.S. Treasury has produced low-risk savings instruments called Series I bonds. They are inflation-adjusted, which means that in addition to the basic interest rate, the Treasury also pays an inflation rate twice a year, and they may earn interest for up to 30 years at a set rate. The extra rate is calculated using the inflation rate. Bonds from the Series I are available for yearly purchases of up to $10,000, and interest is payable for up to 30 years. The last 3 months' worth of interest payments must be forfeited if you cash in the bond within 1 to 5 years, a process known as early redemption. After 5 years, the bond may be redeemed without penalty. Because they can be used as an inflation hedge and are among the safest investments available, Series I bonds are a desirable choice for those who want to invest as safely as possible. Number 2. Certificates of deposit. A certificate of deposit, CD, is a savings account that pays interest on a deposit for a fixed duration. CDs are categorized by term length, or how long money must remain in the account until withdrawal without costs. Term durations may range from months to years. FDIC insured CDs are the safest investment option. Increasing and decreasing interest rates restrict your earnings. Since your money is committed for the contract's life, rising interest rates might reduce your returns. A short-term CD makes sense so you can reinvest at a higher rate later. CDs provide larger yields than high-yield savings accounts, but lock up your money for the period. Number 1. High-yield savings accounts. Similar to a traditional savings account, a high-yield savings account can pay 25 times more than the average rate offered by a typical savings account. Since deposits are covered by the Federal Deposit Insurance Corporation, FDIC, your money is safe in the event that the bank fails, making it one of the safest high-yield investments there is. With a monthly withdrawal cap of 6, high-yield savings accounts also give you access to cash when you need it. Even though high-yield savings accounts pay out more than regular savings accounts, they are insufficient on their own to achieve long-term financial objectives. Instead, they work best for short-term savings objectives like purchasing a car or establishing an emergency fund. That's it for today's video. Hope you guys find it informative. Make sure to give this video a thumbs up and subscribe to our channel and hit the bell icon for upcoming alerts.